Okay, it's 3 after. Why don't we go ahead and get started with our fourth and final session. Welcome everybody again, Transworld advisors and brokers. We appreciate you joining us. We look forward to this last session with you. As always, please, anytime you have questions or want to discuss anything or want us to stop, raise your hand, drop a question in the chat. We've got myself and Heather that will be presenting today, but we got Fran, Nick, and Lynn that'll also be helping. So please, anytime you want to pause us and ask a question, please do so. We'll also have some time for questions at the end. If there's anything that you'd like to bring up from any of the prior sessions or today's sessions, this is your chance to do so. And then, of course, you always have us available to you after these presentations are over. So again, thank you so much and welcome to our fourth and final session, which is best practices in timing and pre-qualification, the pre-qualification process. So for both business and individuals. So let's go ahead and we'll get started with some quick introductions here since, you guys know us pretty well. I, of course, am Joe McAleer again, 18 plus years in the finance industry, been with multi-funding nearly 10, and I've had the pleasure of working with many Transworld advisors and have closed a number of Transworld deals, actually just closed one today. So there we go. Another Transworld closing under my belt. Woohoo. Pleasure to be here.
And everyone, I'm Heather Hoover. It's nice to see everyone again. Thanks for going on this journey with us as we again hit our fourth and final webinar today. I've been with multi-funding for just over 6 years and work on a bunch of acquisitions. I originally was in commercial lending and then a little bit of municipal lending, and now have come full circle and with multi-funding. So with that, let's get started.
So we're going to
yeah, go ahead, Joe.
I was going to say, we're going to start with a poll here. Go ahead and please answer the following question. How many years of tax returns do you need to provide during the pre-qualification process? Is it 1, 3, 5, or 10 years? Go ahead and please drop a vote there. We'll allow for 10 to 15 seconds, 20 seconds for you to do so. But go ahead. How many years do you need to provide? How many years do we need? Or does a bank need? Okay. Allie, do we have a slew of answers there? Okay, it looks like the majority of you have hit the nail on the head. Absolutely. 3 years is what the bank will be looking for, what the SBA requires for their, for their underwriting standards. A couple of you mentioned 5 years. Certainly great to provide additional years, but not necessarily a requirement per SBA standard to have 5. Now, if you're thinking, what if a business doesn't have 3 years? That doesn't mean it's disqualified for SBA lending. It just means that, there's less to go by. But yeah, 3 years is definitely the magic number for working with us for a pre-qualification process. And of course, what the SBA standards are when you're approaching a bank and needing to provide those tax returns. So good job, everybody who answered B. So the seller pre-qualification process, this is what we do to work with you guys as the brokers to pre-qualify your deals and, put it on paper that the business is lendable and you can use that in your marketing and advertising and attract, buyers that may want to use leverage towards the purchase of your listing. So, when we're looking, when you ask us, when you reach out to us And we encourage you to please reach out to us with your opportunities and your new listings, or when you're getting ready to take on a listing. Hey, Joe, can you pre-qualify this business for me? We look to do basically a pre-underwrite or a financial analysis on that business. And what we would be initially asking you for, kind of demanding of you, is those 3 years of tax returns, which we just touched upon. Or if the business is on, the seller's personal returns, which is completely okay and acceptable. If the seller is uncomfortable providing the entirety of their personal return, we would then look for the Schedule C and all of the, all the associated business-related pages thereafter, even the blank ones that would follow the Schedule C on the personal return. That would then make up a quote-unquote complete return that we need. Then we're also looking for current year financials. We like those to be within 60 days current, right? So it's, about to be July. If you send us, Q1 financials, we're probably going to be pushing you to at least, bring those up to April, if not maybe even May, if you can. But we require those current year financials. We need to really have visibility into that ongoing or most recent health of a business. We do request that you provide balance sheets to go along with the P&Ls. If a seller doesn't immediately have those, that's okay. But once we get to the bank, they're going to demand them. You have to have an accompanying balance sheet to a P&L in order for the bank to be able to have that, underwriting package be quote unquote compliant. If, your offering memorandums or your executive summaries, you guys often do such a tremendous job of putting those together, with your recasts in there, extremely helpful. We always encourage that you send those so we can, dive into and learn a little bit about the business that you're selling, and maybe ask some questions about some of the things that we immediately notice that you've included in your executive summary around that business. And then, of course, when you guys have your SDE or your recasts, if there are some things that are, not very easily defined under the acronym EBITDA, we may be looking to you for some proof, some immediate proof of verification of certain add backs. Owner compensation, we may ask you for either immediately or eventually would ask you for the owner's W-2s or 1099s or some proof of those payments. But, those things that jump out at us when we want to make sure that we're verifying that usable EBITDA that's going to lend the support to the loan that's going to help a borrowing buyer towards that purchase. We want to immediately gain visibility to that. Now, not only is this, this effort to give you guys a pre-qualification that has some real meaning behind it, but this exercise really puts us ahead of the game. By working through this process with you, we've already gathered probably about 90% of what our banks or any bank would need to themselves be able to look at a loan and an opportunity in a business and immediately somewhat decide if this is, if they're comfortable with the cash flow and the debt service, and if they feel that the business is qualified. So, there's a lot of value in working with us and going through the motions and working with your sellers and getting this information over, because we do basically function like bankers on the front end of this, and we're going to give you some really good substantiation of what we feel we can do or what a bank is going to be able to do on a loan effort. In addition, on the seller pre-qualification, we're really looking at the cash flow analysis, right? And that'll go hand in hand of what our expectation or the expectations we're going to set on a business valuation, right? You have an asking price that may be based off of seller's discretionary earnings or trailing 12-month SDE, those sorts of things. I understand in the way that you guys present deals sometimes, that may be your basis for a multiple. Banks don't necessarily use multiples. They go right towards cash flow. It's all about debt service. So again, it's back to that usable EBITDA, that cash flow that's available, that ability to debt service a loan. And then what does that look like on a year-over-year basis, right? Is there consistency? Is it stronger in the most recent year? Is it weaker in the most recent year? Are there, some anomalies? Those are the types of things we're going to want to talk to you about, or things that we may be pressing back on that we think could potentially weigh on valuation. I think we had a question that just popped up. I'll pause.
Yeah. From Justin. Sorry if you covered this, but are we able to send valuations if they include a recast pro forma, industry comp, debt to income ratio, recommended multiple of EBITDA and SDE based on a NAICS code? We also show adjusting entries and fully show the other deductions in the return.
So is Justin referring to some sort of like valuation that they've already had performed on the business?
That would be my understanding. Yes.
Yes, absolutely, yes. Justin, we would welcome that, but just keep in mind, we are understanding of the way that SBA evaluators, you guys sat in on the session last week, right? So our mindset is, what are those evaluation companies and what are banks going to be looking for? Many times I've seen independent valuations done by third parties where they don't even gather tax returns and they're valuing a business at, 10 times revenue or 1 times revenue or something like that. We're thinking about the way that a bank and a SBA approved evaluator is going to value a business. So, we welcome any independent reports that you have. And, if they lend very good support to what we see, well, then they're a tremendous tool, right? For you already to have that. So I appreciate that question, Justin, and that could be very helpful if you are going through those motions when you're working to get your business qualified for financing. So back to the mentioning about our cash flow analysis. If we feel that what we see on paper, what the seller has reported, what sort of usable EBITDA we are coming up with, right? And maybe we're discrediting some of the highly discretionary earnings, or there's just some things that we know the banks aren't going to utilize, or things that we can't easily prove. We may be saying to you guys, hey, your seller wants $1 million. The cash flow supports a loan of about 800,000. This is not going to be a 90% loan to value transaction. We're going to have to qualify this business at a slightly lower number, right? So there could be potential valuation gaps, but we'll discuss those with you and how you want to handle that, or if we just need to, write a pre-qualification that calls for a little bit more money down, right? And we'll work with you on that, and then you can decide, how you go from there with your seller and with interested buyers. Now, if the information that's being provided, right, if we get the tax returns and it's just clearly not in support of the asking price, the seller has just buried all their income for years over years, and they're saying, oh, I want to sell my business for $1 million, and we can't find any cash flow anywhere, or it's very, very minimal. We may be saying to you, look, sorry, this is just, because of this factor or these factors, we're deeming this business not financeable. Or, again, as I just alluded to, maybe we're only able to find a loan for 50% of that total purchase price. And then we'll discuss with you, if you want to proceed with a very low LTV potential qualification, or if that's not going to add any value for you to, be advertising the business at a seemingly low, LTV from a loan perspective. If we come to the conclusion that the business looks good, it's financeable, we have that package, we're ready to go, we'll offer you guys a pre-qualification on our nice letterhead. Some of you may have received them before. And it basically says that based on all of these things that we've gathered, we deem this business financeable by way of an SBA loan. And we'll have a nice little sources and uses broken out on that. And again, you can utilize that to go ahead and advertise that the business is financeable. Next slide.
And with that, now we'll cover what's happening on the other side. So when you look at the borrower and what the borrower has to go to, because we want you in your position to know if someone's a legitimate borrower and if they can actually afford to buy the business. And so this is something that we can help for. The most important thing, though, is that, and this is at the bottom of every borrower pre-qualification that we offer, is a borrower in and of themselves. We can present and document, again, how much of a business they can afford. We can do our due diligence on their credit, all that good stuff. We cannot say they're not actually lendable until the business they're identifying to buy, or the business they're buying is identified and that is actually underwritten. So just to clarify that and what we actually are offering with the borrower pre-qualification. So it's a very similar set of documents that the borrower needs to provide to us for pre-approval. And then this is, again, exactly what, when they're going to request lending, going to actually formally request a loan from the bank, this is the information that they need to present to the bank as well. So it's, again, 3 years of personal tax returns and all attachments and K-1s. If they already own an existing business, it's all of the corporate tax details associated with that business. And that also includes current financials, both P&L statements and balance sheet and a debt schedule. Because remember, the bank, when they're looking at this, and we'll get into this more detail, what they're underwriting is the global kind of the global credit and the global cash flow. So they really need to understand also how this business, how this individual's other businesses have been performing, and what their other assets and liabilities are related to the business. In addition, a current resume, a lot of what we need to focus on, and this sometimes obviously comes back in an iteration when we're going to the bank, is, you know, their experience and how that translates to the new target business they want to acquire. So that will kind of come up when we go back to the business, back to the banks, but we need a current resume to show their expertise. Very importantly, their SBA 413, which is a personal financial statement. That's important for a couple reasons. One is not only to detail their assets and specifics, if part of their equity contributions that are going to be used for the transaction, they need to be shown that they're actually available and what they are on the personal financial statement. Sometimes we will also request actual statements. If it's an investment account, we'll ask for the most recent statement for the portfolio. And we'll also ask for some specifics about their personal credit, beyond just their personal credit score, because that is important to lenders. That's the first thing a lender will look at, but also some things that don't necessarily come up in a credit score. Did they have any past bankruptcies? Is there any foreclosures? Things that they might not perceive are a problem now because they happened in the past, they do matter to banks. So with that, again, what we're looking at is the specific of what the borrower can pay. Again, it's going to rely on the business they're acquiring, but what are they bringing to the table and what does their portion of kind of the global cash flow look like? So then what we can do is, again, present a formal letter after our analysis to show how much we think that individual can pre-qualify for. And we're very sensitive kind of for all parties' sake, for your sake and for the borrowers. We want to be realistic with that. We're not going to say, oh yeah, sure, they can, you know, buy a $5 million business. We don't want them to go personally bankrupt, overextending themselves to do so, but we also are realistic and we know how the lenders look at it in the lender's comfort zone, and we can give an actual number. And the way it's usually stated is they can buy a business up to X dollars. So up to $2 million or whatever the actual answer is, to show that there's some flexibility, but we kind of give a ceiling. So, and I guess with that, this is always, we love the responses for this, but when not you, but when the borrower is applying for an SBA loan and you're waiting and representing the seller and trying to get to a close, how fast from the time a borrower applies for an SBA loan to closing, how fast do you think that is? If we can take a second to complete the polls. And as you're completing this, we'll add, we know what we want the answer to be, but we also want to talk about how it actually works.
All right, let's see them.
That is, you guys are right on point. I think this is something that, and I'll let Joe chime in as well, is that an ideal loans can close within 30 days. We do think it's very realistic, most realistic, that it is 60 days to allow for not only the full underwriting and approval process, but then the closing, which includes, escrow and title searches and everything else we need for success. I wish it were 30 days. I think we all do. It is that, again, it can happen, but that is not the norm. And again, unfortunately, a few of you did mention 90 days. That's not out of the realm of a normal process either. And we're going to talk about some of the things that can slow down a process. And if we do our job well, you are always informed and aware of kind of how this timing looks. Because at the end of the day, we want the borrowers to get their money to buy the business, but we also want the seller to understand how the process is going to set expectations on everyone's behalf. So set everyone up for success.
Yeah, that's right. I mean, your answers were pretty spot on. I have closed acquisitions in 30 days, albeit very rare. 45 to 60 is expected. And yes, they can bleed out to 90 or longer. But with our banks, definitely, they are quite efficient. 45 to 60 days, if we don't run into any hiccups or hurdles, I think that is the most realistic timeline for an acquisition loan closing. So I think, was this me, Heather?
Yeah, go ahead there.
Okay. So talking more about your best practices on timing and how do we move loans quickly, right? A standard SBA acquisition loan process with an efficient bank and a very efficient and proficient borrower and an efficient and proficient seller. And probably the most important is timely third-party responses, right? Attorneys, insurance agents, title companies, landlords. Oh my goodness. Those are the folks that are going to help us keep this process moving, quickly and getting to that closing table in a more timely manner. So yeah, that 45 to 60 days, we've been able to do them in less. And again, we like to use preferred banks, very efficient banks. They're quite seamless in their processing. If they're not, we probably are not going to use them for much longer. So, we make sure we go to the banks that we know have the appetite to lend, but also are the most efficient with their processing of these types of loans. We understand that everybody wants to move quickly when they're buying a business, and time kills deals. I'm sure a lot of you brokers would echo that exact statement. So, having a very efficient resource is very, very important.
And so with that, Joe and I are going to just take some time here to walk through kind of what exactly it looks like from start to finish. And so One thing, and Joe mentioned this, we only work with efficient banks because, again, time is of the essence, and time is really what sets these up for success. And the banks are efficient, and again, it takes every other party to also come to the table and to be able to move forward to the process. And really, what we're helpful with is making sure that if, heaven forbid, the banks are kind of being, for some reason, a little bit slow, we can get a hold of the correct person to say, what is next? When's your next credit committee meeting? Where are we in your line of underwriting? When are we going to hear back? So our job is to both keep the banks moving forward, but also to, keep you and the seller in the loop at the same time. And
We have
here,
a
we got a
question.
question here.
Mhm.
Again, from Justin, how do you recommend moving? And thank you for all the questions, Justin. This is what makes this conversation good. How do you recommend moving a buyer away from a local bank that they love but don't have the experience to make a deal happen? Do you get involved in that conversation?
I think that's a good question, Justin. Obviously, I know you guys need to be very careful about, pushing your borrowing buyers towards, one outlet or another. I know you guys have your relationships. We're a relationship. Again, we do consider ourselves rather efficient. I think the best thing that you can be doing, in my opinion, and some of the other folks here may have their own opinions, is, encourage at least a conversation with us, right? You don't have to tell somebody that they can't use so-and-so, because you can't do that. But tell them that, the other brokers I work with, when they get faced with that exact situation, hey, at least have a conversation with Joe. See what he may be able to do. There's no fee for his services. It wouldn't hurt to have a conversation with him, because he works with some really tremendous banks, and we know that he and his firm is able to perform. I would also ask, is your bank, is your local bank a preferred SBA lender or bank, right? I think that right there is potentially going to write the story of whether this is going to likely be a 45 or less or 60-day close, or if this could potentially get ugly, right? And if that borrower is saying, oh no, they're not preferred, but they say they can do SBA, again, that's when there may be some encouragement, hey, we really prefer for our borrowing buyers to make sure they're working with preferred outlets. We've had bad experiences with banks that are, not preferred. They don't do as much SBA loan volume. They tend to run into issues. These are the types of things that I'm sure you can feel comfortable saying to somebody to try to push them, towards a more efficient resource. Aside from that, the hope is, if they will at least engage a conversation with us, maybe we can be convincing enough that they let us take the reins and help them by promising that quicker process. And I know sometimes there can be a little applied pressure by way of your LOIs and from your sellers that certain things need to happen by a certain amount of time, approval in so many days, closing in so many days, due diligence in so many days. So again, if they're setting themselves up for a potentially disastrous loan process, you could be warning them that may in turn result in a disruption of the deal that they have in place, with your seller. Those are probably the safest recommendations that I would have. Fran, Heather, any others, that you've maybe discussed with brokers or with folks that are in this situation?
I think the only other thing I would add is that the lenders that we work with are transactional lenders. And so they're not looking to kind of really dig into the whole retail relationship and the whole business relationship. They are just funding this transaction. So in a way, if it helps your seller, or borrower you're referring, whichever it is, you can let them know they can keep that relationship with their existing bank and the bank they love. And then this can be just a one-off transaction.
It's a great point. Absolutely.
Yeah, I'd say lastly, I mean, not that we want to become a stalking horse in this conversation, right? But the reality is we have a good sense, as would, Justin or another advisor, that a local bank may fall a little short. They still flip a file over to us. Buyer has enough comfort to at least give us a shot, sort of running a concurrent process to an extent, right? We obviously don't want to expend a lot of time on either side, right? If it's not a worthwhile effort, right? But it should be a very quick turnaround for us to get our arms around a file, put a bank in place, and from there, then it, at least gives the buyer some options there. And, maybe the proof is in the pudding a little bit, based on how quickly one lender versus another moves in the transaction.
All great points.
And with that, Allie, can we move to the next slide? So here's what we're going to walk through, and we'll break it down in stage by stage. But this is the start to finish, everything you need to consider to get to a successful closing. And so it starts with, again, the LOI and the term sheet, and that kind of what the kind of identification of interest by both parties and putting pen to paper that this is really happening. And then the borrower will go through underwriting, approval and the commitment of the loan, and then finally to the requirements that are usually outlined in the closing process, but that are just, there's no way around them. They're just loan requirements that have to be met. And then finally, the actual closing. So with that, we'll go to the next slide with the first step, and Joe will cover that.
So yeah, on this first phase of this big topsy-turvy loan process, again, we're going to work with you. We're going to work with the borrowing buyer. We're going to put that entire package together. It's going to be about, I like to say, 85% of what the bank would need to really fully underwrite that loan. It's really just absent the bank's application, their forms, some SBA forms, and the business plan and some projections, and maybe one or two things from your seller, depending on what the bank recognizes. So we're going to put that all together. We're going to present to our banks. We don't apply on anyone's behalf. We don't pull their credit. We build it all out, do all the work for our banks. That's why they love us and move quickly. Here's this opportunity. Do you like it? Do you not? We prepare a little write-up, tell the nice story that they want to hear. And usually within 24, sometimes the same day, 24, 48 hours at most, or, we'll be knocking on some doors. We should be seeing a proposal or receiving that feedback, right? If the bank likes the deal, they're going to propose on it. That's a great sign. We really have high expectations of our resources when they do propose on opportunities, that we're going to be able to get them done in underwriting. And then on the opposite end of that, tell us no, right? If it's not something you can do, or if you just see too many challenges, for your resource, your particular outlet, and you don't think you're going to be able to get there, just move on. Cut us loose. Don't drag us through the mud. There's no value in that. For us as intermediaries, we want to make sure that our banks are being honest with us and honest with everybody. Moving forward, if they feel it's a deal they can get done. So assuming we obtain that proposal, we provide it to the borrower. We allow them, of course, to review it, ask any questions, share any concerns. If they feel comfortable with it, they sign it. The bank will typically ask for a small good faith deposit, something to the tune of $2,500, maybe a little bit more. That is a fully refundable deposit if they do not approve the loan, or should the borrower, something come up in their due diligence, congruently with the underwriting process, that would be a fully refundable deposit. It does not go hard until we engage into the loan closure process, at least not with our resources. I know some other banks out there may take a deposit on the front end, and that immediately goes hard, but at least with ours, we're very protective of people and their money and all that stuff. So that money, that deposit eventually goes towards closing costs and goes towards down payment. So when the LOI is signed, we provide that to the bank, the deposit is made, and now we go to the next phase, which is the next slide, where Heather is going to talk about that.
And before you go on, maybe a quick question.
Sure.
I'm not sure exactly in what reference this is mentioning, but advisors of LaGrange, what's criteria for the banks you work with?
I think, and hopefully we'll hit on some more of these as we go, so you can ask some follow-up questions or bring it up again. But, something that's really important to us, and what Joe just touched on with even the initial stage with the lender getting a term sheet, the lenders we work with, for example, if they give us a term sheet, they've done their upfront analysis and due diligence. We will not tolerate lenders that offer a quick term sheet that then will not approve a loan. And so things can come up. Underwriting might, in the underwriting process, it might, kind of some details about other credit or other issues that weren't identified early. So I'm not saying there aren't problems that could prevent an approval, but the banks that we work with are, most importantly, when they give a term sheet, they're good at what they do. So they've done their upfront analysis. And so that means they should be funding that loan. There's going to be a lot of work along the way to get it. So that's the first thing. I think the other thing too is efficiency. I mean, Joe mentioned in that early on process, I hate to say we love yeses from banks, but we also, if someone's not going to do the deal, we want to hear a quick no, like Joe mentioned. And we also, we know who has an appetite for what type of industries or who's stronger in different regions. And so that's kind of how we get to work with the banks. And then this is an interesting follow-up question about the back offices. And you're absolutely right. There's some wonderful bankers and relationship managers who do all the upfront work. And then you get to closing and just, you can't get a hold of a closer. You can't get follow-up information about what documents needed. And yes, we have fired banks we work with exactly over that process. Closing should just be a matter of getting a checklist and providing the documents off the checklist, and expecting the same responsiveness from the back office that we got from the relationship manager getting to that point. So yes.
A follow-up to that. I'm not worried about the bank approval. Have you seen closes with them? Do you know how their back offices work?
Yeah, so it is really important that they can handle not just the front part, but the back part. And we won't, it's not worth anyone's time to go through a bank that's poor at executing the closing process.
Yeah, and that's also, I mean, I'll add, whoever's, begging the question, that's part of our job. We don't function as simply brokers. This loan gets going with our banks and we disappear and we're on to the next one. We kind of keep our arms wrapped around that entire transaction from start to close. So that's part of our ongoing involvement in our job as the advisors and, as your partners, right? We want to make sure our bank remains efficient, through the underwriting. If there's hiccups, if there's hurdles, if there's slowdowns, what's going on? What are the issues? Why is this taking so long? We're going to push. We'll be there to push through the close. If a closer, if there's some inefficiencies or some difficulties, or we just feel like we're not getting that level of attention and responsiveness that we need or that we desire, or if there's something at the close, a bank feels like they're asking for something that can't be supplied, and we feel like that it's a hurdle we should be able to work through or that they should move on from. We have Lynn on this call. I can't tell you how many times we've gotten to a point in a process where a bank or a bank's attorney or somebody is misinterpreting a rule or asking for something that we know is not an SBA requirement, and everybody's throwing their hands up and sellers are saying, I can't do this, or I can't get that, or, it's going to take me months to do something. We've had Lynn step in and actually educate folks at banks and say, look, you can still be in compliance if you do this or you do that. So, that's, yes, we have lender criteria. And, I will say that I've worked through loan processes with the same banks, and sometimes, they are extremely efficient and you just get the most wonderful experience. And other times you're scratching your head going, what the hell happened? Why is this one so much more painful than the other one? I'm sure you guys have gone through it with some of your immediate relationships, but again, that's part of our job, and we're going to do our best to keep our bank honest to that process and to what we expect in terms of, how they deliver on that loan. So, from a criteria perspective, it's all the things Heather mentioned, but from a ongoing relationship perspective and a grading perspective, it will be that performance from that start to underwriting to approval to close that's going to allow them to remain, a resource of ours and allow them to keep receiving our business. So hopefully that, better answers the question.
Yeah, there's a lot of weekly and monthly changes there, right? Lender gets an influx of deals and they just say their underwriting queue is 2 weeks behind or a week behind, right? I mean, we have to be making real-time decisions and having those daily, hourly discussions with the lender and current status, right, helps us better match a deal that's going to also have a good customer experience along the way. So hopefully that helps. Darlene also had a quick question here. Do you have a list of preferred industries? I don't know if Joe or Heather, you want to take that.
Well, I'll start. And
go ahead,
sorry,
Heather.
and then you guys can add. But I would say overall, we're pretty much industry agnostic. However, we know there's some lenders, for example, that don't love restaurants, or some are better at e-commerce than others. So we are open to anything. The SBA, and Lynn, I'm totally blanking on what the term is. The SBA does not like, there's certain guidelines. The SBA will not fund certain industries. So Lynn, what is the term I'm thinking of?
Well, they won't, there's ineligible industries from the SBA, and no investment properties or anything like that, but they don't have a problem with any specific industry. Some of them, they're much more, well, they won't lend money to businesses of a prurient nature. So no adult dancing clubs, strip joints, things like that. They won't do that. They also have certain restrictions on businesses that deal in religion. And there are certain things that have to be done if there's a religious component. They don't lend money for businesses where gambling is more than 1/3 of their income, things like that. Is that what you were asking about, Heather?
Yes.
Yeah. They don't fund investment properties. They don't fund financial institutions. They don't do anything where the income is speculative or based on fluctuations of the market. They don't lend money for crypto businesses. It's, too risky, things like that.
Joe
But
or Fran, anything
the
else?
standard businesses that you will see buying and selling, I would say that 98% of them are fine.
Yeah, the only thing I'll add is Heather is right. We're industry agnostic, and if it's a particular type of industry, again, we're not like shopping opportunities. We're hand selecting the top 2 or 3 resources within our network that we know are going to be very comfortable, with a particular deal, with the associated risks, and of course with the industry. So yeah, any type of transaction or business that you're trying to sell, don't feel like it doesn't fit our box.
And with that, I will circle back to the underwriting portion of the loan process. So what will post-term sheet from the lender, the bank will send a list of very specific underwriting documents that address, some of them will have to be answered by the seller, or by really you as broker would be the in charge of getting the information, and you probably know some of the answers anyway. So some of it will be about the business being acquired. Some of it is personal about the guarantors, but it'll be a very specific list that will be followed up with or be sent to the borrower. And what takes a little bit of time here, quite frankly, is the responses that are provided to the bank almost always spawn another list of questions. So it's not like you get this list, you respond to everything and they're done. Some of those kind of, create more questions. So it's a little bit of back and forth. So we do usually allow, this is really, a 2-week process. And it really is in a situation where the borrower just has to be quick to respond, and that the borrower is not the one that's holding up the process here. They're providing the documentation quickly. And upon the bank, again, going back and forth and having all those underwriting questions resolved and to a successful end, and everything makes sense to the underwriter, then the banker or the underwriter will provide to their credit committee kind of an underwriting report, and it will be submitted to credit for a loan approval.
One of the things I'll mention about our banks when we talk about efficiency and underwriting that I'm really liking and seeing a lot more of, we talk about this portion with the bank sending a list of initial needs and questions and all that stuff. A lot of our immediate resources are actually, when these initial questions come out from the underwriter that has taken possession of the package, and, I'm sure Heather and Fran have experienced this, a lot of our immediate resources are answering a number of those questions for the borrower, for the seller, based on the things that we've already shared with them, right? Because, you've got another set of eyes on an opportunity, and they're getting through it, they're trying to understand it. It can be annoying when they come back with the same questions that you feel like you've already answered on one end of the process. So, when we talk about streamlining and efficiency, this underwriting process can be a little bit quicker with us, because again, that work we're doing and the relationships we have. So just wanted to add that as well.
Great. And with that, we'll move on to approval and commitment with Joe.
So again, as Heather noted, the underwriting gets completed. That write-up, that analysis, all of that, big, lengthy, more in-depth analysis that the underwriter is prepared gets submitted. Whether the bank has a credit committee or credit officers, most of them these days have like a credit officer or two that have to sign off on a loan depending on its size. And the expectation, or what we typically see, is once that write-up has been submitted, we usually have a response, whether it's a yes, whether it's a no, hopefully not, or sometimes a couple questions from the CO or COs. That'll come back to us within about a day or 2 days' time. If it's approved within another 24 hours time, if not sometimes the same day, a commitment letter will actually be issued to the borrower. That is, of course, the bank saying, we are committed to do this loan. There's no longer a decision-making process on this loan. We are going to do it now, as long as, you meet this lengthy list of needs that is your closing needs list. We will close on this loan for you. So the borrower then signs the commitment letter. The bank will ask for an additional deposit, that previous deposit, that good faith deposit that was refundable will now go hard and be put towards some of the closing costs, and they'll gather some additional monies from the borrower. And again, usually within another 24 hours time or so, the assigned closer will then reach out to the borrower once they've put together, basically gone through and put together the entire needs list to close that individual transaction. So it is catered to That particular transaction, there's a lot of standard stuff on there, but of course, it's individualized to what will be needed on that transaction. And then the closer, becomes the main point of contact. Again, we remain, in the background, keeping our finger on the pulse of everything that's going on, the conversations, the responsiveness, the things that are being provided. We'd like to keep an eye on that. Sometimes, if a closer misses some things or is asking for things twice, we can try to help clean that up. So that's where things go. And as we move towards that loan closure. Next slide, please.
This is the section here with the requirements. This is just part of every loan process, and there's no way around them. They just got to go through them. And we'll talk after we go through the start to finish overview. We'll talk a little bit about what can be hard about closing loans and some challenges that you can face from a borrower's perspective in terms of timeline. So we'll circle back to that. But the first thing is, once that second, like Joe said, the next deposit will be due, these deposits are coming to the bank because they're going to pay for these third-party costs of the loan. So the first cost will be for the third-party valuation. And this is something we generally know, you know what you're going to expect it to be. We have a sense of where we think it's going to be. And quite frankly, the lenders, they do, as part of their their underwriting and their approval process, they know where they think the value of the business is coming in as well. So there shouldn't be any surprises here. Guess what? Every process can, again, have its challenges, and sometimes evaluation does come in lower than expected. So we'll talk about that later. But the what's important about the third-party valuation is this is where it's a third party. It's not the bank taking a long time. It's not the borrower. It's not the seller. It's just a third party. They're usually pretty efficient. So, and they'll set an expectation. And quite frankly, the bank will provide bids sometimes where you can pay X dollars for a 7-day evaluation, 7 days with a little bit higher premium, or just have a normal 10-day valuation at X price. So that's, again, a nice feature. If the borrower is willing to pay extra to expedite, they sometimes have that option, which is nice. The next requirement is, if a loan is not collateralized, there is going to be a life insurance component. So the life insurance is on the borrower, on the guarantor. If there are multiple guarantors, it's the guarantors. And what's important about that is we usually know that, or we do know that early in the process. This is not something we wait for a loan approval to start this process, because this is a whole other timeline. It can take months. And again, we'll talk about the timeline later, but this is something we know is coming if a loan is not fully collateralized. And we'll work with the borrower and encourage them to reach out to certain insurance brokers are very aware of, like the an SBA loan timeline. And there are certain life insurance brokers that can line up their the bids and the actual policies so that they're available in time and will not hold up the closing. And so we like to bring that up as early as possible, but this is where they need to see actual insurance certificates and the actual details of the life insurance policy that will be assigned. Another note is that usually we encourage borrowers, a lot of borrowers come to us and already have a life insurance policy. We encourage them to take out a new policy for these loans rather than assigning other policies that might be intact currently for either, heaven forbid, like a worst case scenarios or estate planning purposes or whatnot. We like them to have a loan just for this so that it doesn't impact, we like them to have a policy just for the loan so it doesn't impact any of their planning for their family or loved ones. This just takes care of making the bank whole. Another part of this is tax verification. This usually is a very seamless process. It's just a matter of completing signing a form that goes back to the IRS. Again, there's sometimes problems with this. Sometimes the bank types up the tax verification and is, instead of street instead of writing out street, just writes ST. That, believe it or not, an odd space or an odd period in an address will make the tax verification bounce back. So again, it's something, and this is why the bank underwrites to taxes and not internal documents. They are getting all of their support and protecting themselves by getting any financials verified by the IRS. So that's part of that process. And then the last part, and again, this also comes back in terms of timeline and some challenges, but this is also where the asset purchase agreement gets finalized, and everyone makes sure from a legal perspective, both parties are signing off and all the language is as everyone had intended. And it does take some, some back and forth and some legal review. This is not a quick process, but this is where everyone is making sure the agreement is documented as the LOI had outlined, but it's finalized here in the asset purchase agreement. And with that, we'll
I just,
hand it back to
right
yeah.
before you go there, I want to switch back to the slide. The life insurance requirement that Heather spoke about is when the loan is not fully secured. But that rule is going to change in the new SOP. I just wanted to add that in there. I am not sure that banks will not continue to require life insurance when it's a sole proprietor or a dentist or a doctor or a business that depends solely on the owner and there's no specific succession plan. But the requirement is there today, but it is going to be relaxed to say to follow the rules of the lender and in what they would do with similarly sized non-SBA loans. So although it may be prudent lending to have life insurance when you're not fully secured, it's no longer going to be mandatory. Just thought I'd add that in.
Thanks, Lynn.
Thanks, Lynn.
Sure.
All right, and lastly here, so the closing process, and I think it's important to touch on a couple things with the actual close of the loan, because I know everybody gets very anxious, the seller, the sell side, when are we closing? When are we closing? Why can't we set a date for closing? It can very quickly become a very frustrating period of time that those last few days or even last couple weeks leading up to a close. So, once the bank has received all of the closing needs, most banks will need a business week's time, or at least allow for a business week's time to pass the entirety of the file to their counsel, their bank counsel, to do a full review for any compliancy issues. And I will say right now, of the hundreds of loans I've closed, transactions I've closed, or whatever, every single time, I believe, attorneys have come back with changes. Fran and Heather can probably echo that, but there's going to be something. It's another reason we encourage you get a final between buyer and seller. It doesn't matter if they sign off on it just yet, but get a final version of the APA sooner than later. Don't save that, till the end or let it drag on and on. Get that into the bank, allow the attorneys to review that earlier in the closing process so they can make their comments and their changes. Because I'll tell you what, when those attorneys start reviewing things, they're going to pick up on things that the closer might have missed, or, that wasn't initially provided, or that may have gone stale, or something being, an I or not dotted, or a T not crossed. They're going to come back with something. So there's that 5-day window, and you can expect to hear within that 5-day window what things they need cleaned up. So once the attorneys, give the full 2 thumbs up that we're ready to close this loan, that's when the actual closing will happen. Now, want to talk for just 1 second, as I was mentioning, the attorney review and all that stuff, and the anxiety of setting a closing date. I will tell you this right now, borrowers and sellers and everybody, as they get closer to the close, they're wondering why a bank will not set a closing date. Our banks are very careful about sticking their foots in their mouths and telling somebody that they're going to be able to close on, the 26th of the month, and it's the 20th, and there's still 3 things that are out there that need to be provided, and they're setting a closing date or setting an expectation on a closing date and sharing that with folks, and everybody's gearing up to do that, and then suddenly those 3 items don't come in, and we're not within that 5-day window of review, and suddenly the bank is saying, guess what, we can't close on the 26th, and everybody gets really pissed off. So I will tell you right now, when the question of when are we closing or when is the closing date is going unanswered, it's not that everybody is just ignoring you. It realistically means that something has not been provided or something has not been fully cleared yet. And until that happens, the bank will not set a closing date. They're very careful, again, about, doing that. They're understanding that people are going to provide documents and do things and start to, prepare for some things. And if that they can't live up to that date, it's going to cause a little bit of havoc. So just be understanding and be patient towards this very end of this process, and getting that closing date. It really quickly becomes, or is all about, all of those materials being provided and cleared by the bank. So we're good to go. 2 thumbs up from the attorneys. A closing date will be set. Typically the seller does not need to do much on closing day. It's the borrower that's going to have to sign a nice lengthy contract, and then ultimately when the borrower signs the documentation, the closing documentation, the bank will, release funds to whoever's the escrow agent, whether that's buyer's attorney, seller's attorney, or if the bank's attorneys are acting as escrow agent, they'll release funds. They'll get the signed documents, back from whomever handled the closing. If there was a mobile notary or something along those lines, they'll give a quick review, and then they will give the official word to the escrow agent. Okay, we are green lighted to go ahead and release those funds, and then the loan is officially closed. Sometimes, as this last point makes, and again about keeping your sellers patient, depending on what time of day it is, if a wire cutoff has been missed, the seller may not be able to receive their funds until the next day, next business day, of course. So, if closings happen a little bit later in the day, or they take a while, or, if there was a hiccup, somebody didn't sign somewhere, they have to go back, correct something, redo something. Oftentimes we fully sign off on deals, but they don't actually fund until that very next morning. So just be wary of that as well. But that's the brunt of the very tail end of your closing process.
So now Joe and I want to discuss what slows it down. What happens to make a 45-day process a 90-day process? And so one thing that's important to keep in mind here is that the banks are never setting a timeline. They're never saying to the borrower, you need to have these updated financials into us by X date. You need to do this by this date. So the process is really driven by the borrower being organized and providing the information in a timely manner. Because the bank, if they're waiting, they're just going to go focus on the other loans that they're working on. They're not going to be begging for the information. So that's something that's really important. And that's something we really emphasize to the borrower is, listen, you're driving this train. You've got to be responsive, and we'll send them reminders if there's an outstanding document or whatever's needed. And then on the flip side of that is if the seller is not proactive, because a lot of the information either in underwriting is coming from the seller, if they have some specifics about the operations of the business, That's also true. It comes up again in the valuation. The bank, when they're hiring the third party valuation expert, they're not using information that's perceived to come from the borrower. It needs to be independent and get the information, the financial information directly from the seller. And so that they are then providing an objective valuation. And so again, that could be another example of just a seller also needing to be proactive to set the loan process up for success. This is another thing, and Joe mentioned this, and he might want to circle back on it again, but the APA is something that we consistently see, because rightly so, it is the document that's going to detail the transition, exactly what the specific assets being that are included in the transaction. And so understandably, this is a slow process, no matter how quickly everyone wants this part to go. But again, it's not just the buyer and the seller, it's the buyer's attorney, it's the seller's attorney, and it just is really, I think, to set expectations, not that anyone wants to be rushed, but it's a very delicate balance of this conversation, everything trying to get down on pen and paper. I thought Joe made a really good point about getting it all down early. It can be adjusted or signed off on later, but don't wait on this, because a bank cannot move forward until the APA is finalized. And Joe, I'm going to let you talk about here the landlord specifics too, and I know we'll talk about it later as well.
Yeah, so one of the things that I think is very important to talk about, which has disrupted a number of my deals this year, and I don't know if it's the economy or what it is, but I've had a lot of lack of cooperation from landlords. A lot of these transactions have lease space. I know you guys do a lot of brick and mortar businesses, or businesses that operate out of a business space, right? So the SBA has their leasing requirements, which I think we had talked about, but essentially, if just to quickly rehash on those, right, is really the SBA looks for the ability for someone to have the option to remain in that space for the life of the SBA loan. Most of these SBA loans are 10 years, so you're seeking a landlord that is willing to allow for either the transition of an existing lease and however many years is left on that, along with lease or lease options that would then amount to 10 years. So we don't have to necessarily make everybody lock into an entirely new 10-year lease agreement, but the borrower that is going to enter into this lease space and have this loan obligation needs to have the ability or the option to stay there, especially if the business is really, really tied to that space. If we're talking about a business that just operates out of any old office and really can easily be moved or can easily relocate, maybe we can work around the inability to get a landlord to sign off on an extensive lease. So we're going to need that. We're going to need that cooperation. And we're also going to need a subordination agreement from a landlord. Basically states a couple things. I mean, first and foremost, it states that the bank has the ability to access the property to collect any of what they consider their collateral, their property, right? Anything, furniture, fixtures, computers, inventory, you name it, anything that's, not necessarily tied down to that space or doesn't belong to the real estate owner and indeed belongs to the borrower. I mean, that technically belongs to the bank. So, they want a certain amount of time that the landlord is not allowed to remove the tenant to where they can come and claim their property, but also allow the tenant a little bit of time to rectify maybe a slowdown or a missed payment or something along those lines. Now, this is where a lot of landlords, and again, I'm noticing this a lot more these days. It really is oftentimes less about, the lease options. It seems to be coming more about this subordination agreement. You're getting a lot of landlords who just do not want to cooperate. They don't want to allow a certain amount of time. They don't want to allow this. They feel that this subordination agreement is a little bit invasive or restrictive for them by nature. I will say this, that, banks will send what can often seem like to a landlord a very egregious agreement, but they do allow landlords to redline that and send back the things that they would like changed. Now, if a landlord says, oh, you have 2 days to enter a property and the bank is asking for 30, well, 2 days is not going to be enough. So, we can get caught in this crossfire and things could quickly turn rather ugly. I've also seen a lot of landlords, using these transactions as an opportunity to show, how great they are and how much control they have over, whether or not they're going to let somebody into a space. So I just want to, hammer it home here that I know there's a certain amount of period of time that, sellers want to wait to notify their landlord and approach them about the fact that they're selling their business. And oftentimes, I've seen these conversations wait until the very end of this process. And I will tell you right now, in this short 6 months, nearly 6 months of this year, I've already had 3 deals blow up at the closing table, because a landlord absolutely positively refused to cooperate with what the SBA requires and what the bank was requiring to be able to close on that loan. And we tried every which way. We offered all sorts of additional security deposits and all types of things, and had the seller threatening the landlord to a degree. But I think it's important for you guys to know, as this is your side of the transaction. Have those conversations with your sellers. Hey, what's your relationship with your landlord like? You're dealing with a borrowing buyer. This is going to be required. That's going to be required. Do you feel like we're going to run into an issue, to get these things? And if you feel like, if your seller is saying, I don't love my landlord, or yeah, he or she is a really tough person to deal with, or we have to go through this property management company that takes weeks to respond, and and it's 10 degrees of separation to get to an actual property owner. These are things that we talk about timeliness, we talk about deal disruption. Don't save this to the end. I'll say it till I'm blue in the face, because I don't want it to ruin any more really good deals when you just have a landlord that needs to be part of this and won't cooperate.
Joe, again, landlord's waivers are also going to be left up to the whim of the lender.
Good.
And that is going to make you very happy.
Absolutely.
I do believe that every bank is going to have a different opinion, but I'm pretty sure that if the majority of their collateral is in leased space, a landlord's waiver is going to be required.
Yeah,
so
absolutely.
that's just to protect themselves. So, there may be a little more leeway than there ever was before, but in general, they will do whatever they do on their similarly sized non-SBA loans.
Yeah, that's good. That's great to hear, Lynn. The point here being just remember, brokers, engage those landlords, make sure that they're, going to cooperate. All right. And that brings us to the conclusion of our last and final session here. We really, really appreciate all of you attending. Let me take a moment. Are there any questions that anybody would like to ask? Again, any of the sessions, today's session, you have Lynn here, you have myself, you have Heather, you have Fran. Are there any questions that you feel could add value that we can answer for you right now? I'll give you guys a moment to go ahead and and ask anything that we may not have covered for you. Otherwise, we will have a follow-up for all of you that did attend all 4 sessions. We are, of course, going to select one of you to win a $1,000 gift card. We have the slides are, of course, all going to be available. The recordings will be available to you, but we will be following up and announcing who is our prize winner. Did we have a question? I saw a Q&A pop up.
Just to thank you.
Okay. Thank you. Thank you guys. Thank you so much. Thank you for spending your time with us, allowing us to have these sessions with you. We really love educating. We love working with you. We're excited to see some deals. Again, please reach out to us anytime you have anything, any questions. Rule changes are coming. You're going to hear a lot of different things. You're going to read a lot of different things. Please use us as a resource, folks that you can lean on, even when you want to just verify something or talk through something. So yeah, really appreciate all the thank yous that are coming in. That means a lot. We really enjoy this relationship. Anything else that anybody wants to add before we cut everybody loose?
I just want to add one more thing that does come up, and this is, like Joe said, please reach out to us and ask for questions. We have had some lenders or some deals come to us where they say, oh, the lender said we can't do this deal because of the SBA guidelines, or we can't do that. And because Lynn is such a valuable resource and our experience getting these projects done, we know when a bank is saying that just to cover up a deal they might not want to do versus a deal that is actually can be SBA financed. So just sometimes banks are blaming the SBA for things that are not true. And sometimes it's something another bank will be comfortable with. And we have a pretty quick read at what can and cannot get done.
Absolutely. Well, thank you so much, Transworld. Thank you to my colleagues for sitting in and helping with this final presentation. And I hope everybody has a wonderful day. And I hope that we will be talking deals with all of you soon. And we'll be in touch about the $1,000 gift card.
Yeah, good
Most
luck.
importantly.
Thanks, everyone.
Bye.
Thanks. Bye-bye.